Data-heavy days weigh on investors. Welcome to Market Insight. I'm David Pollard. Record highs on Monday, caution on Tuesday. European share markets are wavering between risk-on and risk-off sentiment as a new month begins, with a stream of data pointing up hopes for an ECB rate cut later this month, but the data itself, mixed with political upheaval in France and Germany, pointing to uncertainty across the Eurozone economy. Not forgetting, of course, the US, where a sea of output and jobs data could prove choppy water for markets there as they head towards this month's FOMC. Well, let's get a view from Kathleen Brooks, Research Director at XTB. Welcome, Kathleen. Many thanks for joining us today. So we've seen record highs for European stocks over the past days as Eurozone inflation came in at its lowest in 3 years, but the path for markets from here looks littered with potential dangers, doesn't it?
I mean, you would think that. France doesn't have a government, and the French CAC has actually been lagging the broader European indices. However, Germany is a really interesting one because the DAX has made record highs. It's been doing incredibly well, although we've seen economic upheaval and also some political upheaval in Germany as well in recent days. The DAX seems very immune to Germany's domestic problems right now and continues to march higher. And a lot of that is actually because it has a very export-orientated market. So it's much more linked to global growth. Even those worries about China, for example, which is a big trading partner of Germany, doesn't seem to be denting sentiment of the DAX right now. So kind of what the macro picture is painting and how stocks are performing, they're not really on the same tracks at the moment.
So on the question of the German economy and the wider Eurozone, Reuters has been reporting that ECB policymakers are increasingly at odds on the outlook for growth, with some focusing on lingering inflation pressures, but others fearing a recession, a prospect. That prospect must seem possible after yesterday's factory PMIs, doesn't it? And what do policymakers, what do you think they're going to do from here?
I think you're right that the ECB is very much split down the middle. We are definitely seeing manufacturing data is really weighed down by Germany. I mean, the German PMI picked up a little bit in August, but it remains really mired in contraction territory. You would potentially expect that in Europe in August. A lot of factories closed down, but this has been a theme for most of the year, certainly for Germany anyway. And I think what you're seeing are these two factions. What's really interesting is that the German economy is the real problem child now of the Eurozone. Yet it's the German ECB policymakers who are much more worried about the inflation outlook and particularly sticky service price inflation, which actually ticked up last month, whereas the other components of inflation fell lower. They're more worried about that than they are about growth. So they're urging caution about rate cuts. And yet we're seeing other policymakers, for example, from Greece, from Portugal, they're calling for a bit more caution when it comes to cutting interest rates, in the sense that you need to cut them quicker than what the market is pricing that the ECB will do for 2024.
Let's move on to the debate in the US, where factory PMI data are the key numbers there today. And ongoing contraction is expected too. That comes ahead of the big reading of the week, non-farm payrolls on Friday. Markets seem convinced that inflation is beaten. But has the Fed gone too far in suppressing the labour market in the US? And where will policymakers in the US go from here?
I think it's a really good point, actually, because if you go back to last month, it was this start of the month data, the manufacturing PMI and the payrolls report, that really spooked investors, and they started to get very worried about the economy. And that's what caused that risk-off sentiment at the start of August. Now, we've bounced back from that. There's been a strong recovery, but it still showed data points matter. And if we see more weakness or we see some unusual data, then that could trigger volatility this month. Now, what's been interesting is that since that August, the data that we got at the start of August, we've seen the market rush to price in interest rate cuts from the Federal Reserve. There's now 100 basis points of cuts priced between September and December. That does look a bit rich from where we're standing. We don't think that necessarily will happen. And so we could see a bit of a recalibration of rate expectations on the back of this data, particularly the labour market data. If we see stronger payrolls growth, maybe around that 200,000 mark, and even if we see the unemployment rate tick down a little bit, which is a potential, and that could happen, even though that would probably happen on technical factors, then we could start to see the market just recalibrate what it means for interest rate cuts this year. Whilst that could have a short-term risk-off effect, because the markets do like interest rate cuts, overall, we think that it would be very short-lived because it would mean that the US economy is actually stronger than what we thought at the beginning of August. So I think a strong labour market report will be good news for US markets going forward.
Let's also briefly look at one of the day's big corporate headlines, Rolls-Royce that is, which is recovering after a big drop in its share price yesterday after Cathay Pacific said it was grounding aircraft due to a fault of a part made by Rolls-Royce. Is this just a small bump in the engine maker's recovery story, or is it a pointer to something worse?
Yeah, I mean, it seems like it's not as serious as people thought yesterday. The market is very sensitive to anything around airlines and quality control, safety control. But it does seem that was a bit of an overreaction, that it was actually due to another factor, and that Cathay Pacific planes will be up flying again. So Rolls-Royce is making a strong recovery, which is good for the UK market, because Rolls-Royce is actually the strongest performer on the FTSE 100 this year and is up 60%.
Okay, Kathleen Brooks, Research Director at XTB, many thanks for sharing your thoughts with us today. That is Market Insight. You can watch more videos on Reuters.com.